First of all, retailing has been generally okay. People have been somewhat surprised by that. What we do know is that if housing's okay, generally retail's okay because there's a wealth effect on property. Historically, people always used to talk about David Jones and Myers having good sales when property prices were strong. Well, property prices have been pretty strong, and even though people have been fretting about a little bit of weakness early in this year, it's been pretty marginal. And particularly now that we've had the interest rate cut, which has been passed on pretty much in full by the banks, that's going to be supportive of housing and retail. At the same time, it's not the last interest rate cut, almost certainly won't be the last interest rate cut, so another 0.25%. Labor's been pretty good too. Unemployment rates sort of held, employment growth, albeit, you know, you could argue that it's been biased more to part-time, whatever, but that's been holding up as well. So Australia seems to be sort of okay at the moment. But if you go back before basically the IT boom, mobile phones, better communications, higher computing power, profit margins could be higher for longer because it took time for businesses to react more to new information. Their logistic chains were lower, their inventories were higher. So for a competitor to react, again, it was slower. For a consumer to react, much slower. Now consumers can react very quickly because they can see what prices are moving in their handheld device to some extent. They can search, they can, you know, it's very easy for them to do that. So when you look at it all together, there's been a lot of pressure on margins because the intensity of competition, Porter's 5 forces, intensity of competition has increased in a number of ways and profit margins are down here to stay. So when you go back again to the 70s and 80s, we had higher profit margins, we had higher rates of growth, and from time to time the profit margins would swing up, swing down. I just don't think we're going to see those dramatic changes and swing up and swing down. I think they've come down and they're not going to go up very much. But you know, we're in a low growth environment, so what does that mean? So comes back to low inflation, low growth, perversely or paradoxically, high PEs because asset prices are high relative to low interest rates. So we have high-ish price earnings multiples on the market, something that with growth is even more valuable again. So that can kick PEs up to, you know, what otherwise would be thought of as silly levels, like, you know, into the 20s or even 30s. But then, of course, if there's some sort of problem, the leg's kicked out and there's a panic and the share price will fall all that much more. And I think that applies for the market as a whole. So I think that, you know, going forward, there's scope for prices to go up. Like I said, I'm on balance and bullish, not bearish. But I think you can't be calm about it because the prices will rise, but they're going to be more volatile going forward.